started. We get started. Welcome, welcome, welcome. We're gonna be doing some MACD trading today. Type one in the chat. If this is your first time in the MACD, your first time ever hearing about the MACD, about to see the MACD. Type one in the chat if this is first time. Also, if you never used the MACD. We got one. We got one. Good, good, good. All right, guys, welcome, welcome, welcome. We're going to be doing a moving average convergence divergence class, also known as the MACD. Here's the intro to it. Here's a way to also profit in the market. All right, here's a way to also profit in the market. This is another indicator, or as we like to call it, an oscillator, another confirmation in the market to get in and out of trades. All right, so welcome, guys. We're going to get to the bag. So why do we use why do we use indicators? All right, why are indicators used? Oscillating indicators are to show securities when they are overbought or oversold. That's what they show. The market overbought, or they show the market oversold. All right, allowing the trader to get in and out of the trade quickly as possibly. It gives you the best entries and it gives you the best exits. All right, so it's going to let you see those signals to get in the trade and also get out of the trade. So that's why indicators are used. But indicators are also used by those scalpers. All right, those scalpers love indicators, and that's okay because scalpers love to get in and out of the market as fast as they can. All right, so if you are a scalper, this is a great method. This is a great indicator for you. All right, so what do scalpers want to do in the market? They want to get in and out of the trade possibly. So one, scalpers don't use a stop loss. Let's be real about it. They don't use stop losses. They're glued to their phone, looking at their phone or their computer, and they're waiting for that quick entry or that quick exit. All right. So they're not going to be using the stop loss right away because they're not looking to hold that trade no longer than in 5 to 15 minutes. All right. In that trade zone. All right. So scalpers look for at most 20 pips, at most 20 pips in the market before going to the next trade. They're 10 pips in dip, 5 pips in dip. They're getting in and out of the market. So scalpers are not holding any trades for more than 15 minutes. After 15 minutes, they're looking to exit that trade and get into the next trade. So look, what they're looking for is to get in and out as fast as they can, in and out. And this indicator is great for scalpers. So what is the MACD? The moving average convergence divergence, also known as the MACD, a technical indicator used to identify new trends, momentum, and show the connection between the price of two moving averages. All right, you're going to be using two moving averages on this oscillator. All right, the MACD fluctuates above and below the zero line. The zero line is going to be your baseline. All right, a zero line is going to be a baseline in the market for this indicator. All right, so it's going to show the trends of moving averages when they converge and diverge. In other words, it's going to show when the EMAs on the MACD is going to show when they cross, when they converge and diverge. All right, when they cross. So there's a histogram on the MACD, and this zero baseline is where the histogram lies. All right, the zero baseline is where the histogram lies. So again, what is the MACD? It fluctuates above and below the zero lines, which is known as the histogram. All right. It's going to be known as the histogram. Also, the MACD shows when there's momentum. All right, there's momentum in the market along with connection between prices of moving averages. Again, two moving averages. All right, it's going to be two moving averages. All right, so here are your three components of the MACD. All right, used to give your signals. Three components of the MACD used to give your signals. The MACD line. Now, guys, it's going to be the history behind the MACD, and then we'll get into how we enter and exit markets, and we'll go to the charts. So write these down. All right, write these down. I'll go slower on them. The three major components of the MACD used to give signals. All right, a little bit of history of the MACD. You have the MACD line. All right, is the result taking a longer-term EMA and subtracting it from a shorter-term EMA. All right, these are going to be how you get calculations with the EMAs. All right. This is going to how you get calculations with the EMAs. So your MACD, what you need to know from this is that your MACD is your blue line, your blue EMA. Your MACD is your blue EMA. The signal line, the EMA of MACD line described in one component, all right? It's going to be one component, one baseline. So what you need to know for signal line is that the signal line is going to be your orange EMA. The signal line is going to be your orange EMA. In the histogram, it measures the distance between the MACD and the signal line, the difference between the two oscillators around the zero line. So it's going to take the difference between the MACD and the signal. It's going to give you that histogram configuration. All you need to know for the histogram is that the histogram shows the bulls and the bears. All right. The histogram shows the bulls and the bears. So again, the MACD line is your blue EMA. The signal line is going to be your orange EMA. And the histogram is going to show your bulls and your bears. It's going to show who's in control of that market right then and there. All right, on your MACD chart, on your actual indicator, all right, in the MACD chart, there are going to be three numbers for your settings, all right? There's going to be three numbers for your settings. You're going to have the faster moving average, all right? What this does is the number of periods that are used to calculate. It's the number of periods that are used to calculate. The slower moving average is the number of periods that are used. And the difference between the faster and slower moving average, all right, is going to be the number of candles that are used to calculate. Again, these are the history behind the calculations, all right? This is the history behind the calculation. You're going to have a faster, a slower, and they're going to have the difference between the faster and slower EMAs. So this is how you're going to get your calculations. Here's your example. The most commonly used MACD parameters are 12, 26, and 9. All right, here's how we interpret this. Write this down. The faster moving average is going to be 12, all right? It represents the previous 12 days. The slower moving average is 26, all right? 26 represents the previous 26 days. Let's get the difference. The difference between the faster and the slower moving average. 9 represents the 9 days average, or 9 days moving average, or the variation between the fast and the slow. All right, the fast and the slow. It's going to give you that difference. So it's going to give you the difference between those two EMAs, and it's going to plot you a number. All right, this is the history and the calculation of the MACD. This is how they get those numbers. If you're a mathematician, great job. Congratulations, you understand it. But this is the history behind the MACD numbers. Now, are these numbers so much important? Not exactly, all right? Not exactly, but you want to know what you're looking at on your parameters. You want your parameters, all right, I know my fast EMA is going to be a 12. I know my slow EMA is going to be a 26. You wouldn't know that if that was not presented to you. And now you know the difference between them is going to give you that 9 number, all right? It's going to give you that 9 number. So let's talk about those calculations. How do we get that calculation? The MACD line, all right? The MACD line. The 12-day EMA minus the 26-day EMA. That's going to be your calculation. Your signal line is going to be the 9-day EMA of the MACD line. This is going to be the number of the 9-day EMA of this. And the MACD histogram is going to give you that MACD signal and the MACD line. That's what's going to be on your on the whole entire MACD. It's going to have you the signal line and the MACD line, which is going to be the blue line and the orange line. All right, the blue line and the orange line. So what does this all look like? What does this all look like? The MACD, all right? This entire diagram here is the MACD. The entire diagram is the MACD. The blue line is your MACD line. The blue line is your MACD line. The orange line is your signal. This is your histogram. This entire volume here is your histogram. All right, now we have the histogram, which is going to be bulls. Blue for bulls, red for bears. All right, histogram bulls and the histogram bears. Shows the sellers are in control, shows the buyers are in control. Now, these histogram bars, when you see these histogram bars getting dark, when you see them getting dark, you know that there are strong buyers, strong buyers. But when you see them getting lighter, the buyers are starting to die down, but they're not done yet. Just know that there is a pullback getting to happen. All right. There's a pullback starting to happen in the market because the buyers are starting to lose control and the sellers will start to take over. So that strong buy is going to be dark blue and that pullback is going to start being that light blue. All right. Going to be the light blue. Again, your signal is orange. Your MACD line is going to be blue. Histogram bulls and the histogram bears. Your baseline is 0. This is where the histogram lies. So how to use the MACD? How are we going to use the MACD? The MACD has two moving averages with different speeds, a fast and a slow moving average, a fast and a slow moving average. The MACD line and the signal line. All right. If a new trend occurs, the fast line will start to cross the slower line. The fast EMA crosses the slower EMA. For this reason, the fast line will diverge or move away from the slower EMA, often indicating a new trend. So let's break this down. Let's put this in layman terms or Barney style. The blue line will cross the orange line, indicating a new trend. Simple as that. Simplicity. The orange line will cross the blue line, indicating a new trend in the market. So how to use the MACD? Your blue line is going to cross the orange line and it's going to give you a new trend in the market. All right, EMAs on your physical candle chart. Your EMAs on your physical candle chart. The 6 moving average is going to be blue. The 26 moving average is going to be red. And your 14 moving average is going to be yellow. 6, 26, and 14. Blue, red, and yellow. Your 6 is your fast EMA. The 14 is going to be the yellow EMA. It's going to be your 14 slow. And your 26 is going to be a lagging EMA, even slower EMA. 6 is blue, 26 red, 14 yellow. This is going to be your actual candle chart where the candles are on the chart. So let's talk about oversold and overbought, because this is what the MACD actually indicates, an oversold and overbought market. We want to see the obvious trend. We want to see those bears getting out, and we want to see those bulls getting in. We want to see those bulls getting out, and we want to see those bears getting in. We want to see the obvious trend. So how do we indicate oversold, overbought? A cross of the MACD line, the blue line, and the signal line, the orange line. So when the blue and the orange line, when they cross, this indicates an overbought market when this is on top of the histogram. All right, when this is on top of the histogram. When the orange and blue crisscross on top of the histogram, this indicates an overbought market. What do you think we're going to do in an overbought market? Type what we're going to do in an overbought market. Are we going to buy or sell in an overbought market? You already know how to trade this. Good job. You already know how to trade this. Now, a cross of the MACD line and signal below the histogram indicates a oversold market. So what are we going to do in an oversold market? Correct. We're going to buy. So we have an overbought and we have the oversold. This gives us the obvious trend. This is going to give us the obvious trend. We obviously see that the cross overbought and it starts to sell. We see how strong this histogram is. We got our dark red. All right, we got a little bit of pullback, but that doesn't tell us to get out. We'll go over that. But we see the sellers are in control. They're completely in control. And then we have an oversold. They cross. We have an oversold. Now we see that the bulls are starting to get in control and they're completely in control. So let's talk about those entries. Entries, buy and a sell, all right? For buys and sells on the MACD. This is on the MACD itself. When the MACD line crosses the signal above the histogram, all right? When the blue line crosses the orange line above the histogram, this indicates a cross of the 6 moving average and the 14 moving average, the yellow and the blue on the candles, which is going to be your shift of the candles. All right. When the MACD line crosses the signal above, which is the orange line and the blue line, when they cross on the MACD above the histogram, you are looking for the indication of the 6 moving average and the 14 moving average. They are preparing to shift in the market. This is also known as our shift candles. All right. This is your aggressive entry for a sell. All right. This is your aggressive entry for a sell. Why? Because when they cross above the histogram, what does that mean? When they cross above the histogram, what does that mean? Are we overbought or are we oversold? Correct. We're going to be overbought. We're going to be overbought on top of that histogram. So we're going to be looking for those sell opportunities. This is our aggressive entry for a sell. But we're also looking for that confirmation that the moving averages on the candles are going to cross. All right. Now, when we're looking for a buy, we're looking for a buy. When the MACD line crosses the signal below the histogram, this indicates not only oversold, but indicates that the 6 moving average and the 14 moving average are preparing to shift for a buy. All right. So aggressive entry is for a buy when you see that oversold and when you see that overbought. When you see the oversold market, that's your aggressive entry. When you see the when you see oversold, overbought, that's your aggressive entry. Now, this is going to happen before your shift candles. All right. This is going to happen just before your shift candles. That's why this is an aggressive entry. Because with this aggressive entry, with what? There becomes drawdown. Of course, you get drawdown. All right. You get drawdown when you enter a market early because the market may not be done pulling back. All right. Whether it goes up or goes down. But these are your entry indications for your buy and your sell. So look at here. We have the cross of the blue and the yellow or orange, the MACD and the signal for a sell. Type of 2 in the chat if we see that. Cross of the MACD and the signal for a sell. When we come into that sell, we're going to look down to our histogram. And we want to see those bears actually starting to get in. And we see these bears. So now that we see these bears, it's indicating that the bears are going to start taking over. Why? Because we know that we have an indication up here we're overbought. Also, we have an early entry in the market. It's our sniper entry here. But we see that the bears are getting ready to take control. A new trend is starting to occur. So therefore, we're going to look at our candles on the EMAs on the candles. And we're going to look for that shift. All right, we're going to look for that shift. All right, we got 3 confirmations coming up. But you see the shift of the signal in the MACD, and then you see the bears getting ready to take control. Same thing for the buy. We see the shift of the signal in the MACD, and we see those bulls getting ready to take control. We're looking at our histogram. Remember, look at your histogram. We got this bar here, very strong buy. Also our buy indication. So therefore, we're oversold, getting ready to go up in the market. Type of 5 in the chat if we see that. Simplicity. Good job. All right, so let's talk about our confirmations. More confirmations to take the trade. When you see the 26 moving average, the red line is above the 6 moving average, the blue line, and the 14, the yellow line. So when you see the red line is above the yellow and the blue line, this indicates long opportunities. The reason for this, because the 26 moving average is a lagging EMA. It is a much slower EMA on the candles. So it's going to move slower over like a cloud. But when you see this on top, you know that you're getting ready to have long opportunities. All right, long opportunities, which means buy in the market. When you see the red line below the blue and the yellow line, this indicates a short opportunity or a sell. All right, or a sell. Why? Because this 26 moving average is a lagging moving average. Therefore, it's going to move slower than the 6 and the 14. All right, when you see the blue line cross the yellow line, this indicates a shift in the market, also known as our shift candles, the shift of the candles. So here's your tip. If the blue line crosses the yellow line in an upward angle, we are looking for a buy opportunity. This is on your candles, your candle chart. If the blue line crosses the yellow line in an upward angle, we are looking for a buy opportunity. If the yellow line crosses the blue line in a downward angle, we are looking for sell opportunities. Blue goes up, we're looking for buys. The yellow crosses the blue going down. We're looking for sales. These are the shift in the market, shift of the candles. So write these down. 3 confirmations up here and the tips down here. Any questions, guys? Any questions? We'll get into the charts on real time, on real live trade. All right, so what are we looking for? Here's your 3 confirmations. Write these down. This is what you're looking for to take your trade. Look at the MACD. All right, look at the MACD. Is the crossover happening above or below the histogram? Look at your MACD and see if it's happening above or below the histogram. See where that cross is at. See if it's overbought or see if it's oversold. And you're going to wait for that cross. Next, you're going to look for the blue and the yellow moving averages to cross over. You're going to wait for the blue and the yellow, which is on the candles, to cross over. Now, remember, the overbought, oversold crossover is your aggressive. You could wait for the moving averages to cross over on the candles, which is your blue and yellow. That is your set confirmation. Number 3, look at the position of the red moving average. Is it trailing above or below the blue and yellow EMAs? Is it above or below the blue and yellow EMAs? This is also going to let you know if you're in a buy or a sell, or if you're going to long or short the market. So these are your 3 steps. Look at the MACD, find the overbought, oversold. Look at the blue and yellow line, see if they shifted. And then look at the position of the red moving average, see where it's at. All right, here is your exit on the MACD. All right, here's your exit on the MACD. If you were in a buy, write this down. If you were in a buy, during buy opportunities, the MACD, the blue line and the yellow line, will start below. They're going to start below and move above the histogram. When the blue and yellow line cross over above the histogram, you exit the trade. When the blue and yellow line goes above the histogram, you exit the trade or you make it risk-free. So again, during your buy opportunity, the MACD is going to start below in the oversold position. It's going to move above the histogram. When you see the blue and yellow line cross over above the histogram, you exit the trade or you're going to make it risk-free. This is your exit. Now, same thing for a buy, or sorry, same thing for a sell. During the sell opportunities, the blue and yellow line will start above and move below the histogram. When the MACD and the signal, the blue and the red line, sorry, the blue and orange line, you exit the trade. When they cross below the histogram, you exit the trade. So your sell is going to start above the histogram and it's going to go below the histogram. When the 2 EMAs, the yellow and the blue, when they crisscross, you're going to exit the trade and you're going to make that trade risk-free or exit. You take your pick. Type 1 in the chat if you understand that. That is your exit. You're going from an oversold to an overbought market. Overbought market to an oversold market. All right, so where do we put our stop loss? All right, where do we put our stop loss? Nothing changes on stop losses, guys. Nothing changes on stop losses. You're going to place your stop loss spread times 2 above the lower high of the day, behind support and resistance, or you're going to be calculating that ADR for your stop loss. Those are your 3 options for your stop loss. Always, always, always. Calculate the ADR or find your support resistance areas and put your stop loss behind it, or do spread times 2 above the low or high of the day. These are your 3 options for your stop loss. Nothing changes on that. So here's your buy opportunity. Here is our steps. Step 1. Look for that overbought, oversold market. We have an oversold market, so we're looking for the cross of the orange and the yellow, or sorry, orange and blue line. We see those buyers getting ready to go, so we look up at our candles. We see the shift of the yellow and blue EMA. They look amazing, great. We see the red lines on top. If the red line's on top of the blue and yellow, that's a buy opportunity. All three matches up, we take the trade. Type a 7 in the chat if you see how that lines up. Awesome, awesome. All right, so let's get into a live trade. Any questions before we get into a live trade? Anyone need me to go back? All right, we'll get to the chart and we'll do like 2 or 3. It's a simplicity guide. I made this as simple as I could. Let me get out of this and go to a chart. Let's go. And we'll go here. We'll do your chart as well. So let's see. Let's find a trade. All right, so everyone see my screen? We're all here. We're all good? All good. Okay, awesome. All right. All right, so guys, we come to the market and we see this. Let's back up just a little bit. We come to the market and we see this. All right. We have our MACD. So again, we have the MACD. All right. We'll go ahead and we'll just label these. We have the MACD line. We have that MACD line. And then we have the signal line. We have our signal line. And then we have our histogram bulls. Histogram is bull right here. We got our histogram bulls. All right, we got the bulls right there. We have the bulls. Now we know that we're getting ready to get into an overbought market because these the EMAs are on top. So what we're waiting for is for the buyers to just be done. Wait for them to be done. Wait for them to be done out of the market. All right. So we have our strong buys, these dark bars on the histogram, and then we have the light histogram bars. We know the pullback's coming because these are getting lighter, and the bulls, these bars are dying down. All right, these bulls are dying down. So we're going to wait for the cross of the EMAs up down here or up here, either or. If you're aggressive entry, you can get in here. If you're conservative, you wait for the cross of the EMAs. Also, we look at this right here. What does this mean? What does this red line mean when it's on the bottom? What is that telling you already? What are you looking for? When the red line's on the bottom of the yellow and the blue, what are you looking for? Looking for a sell, correct. You're looking for a sell. So you're already in an indication that one, you're looking for a sell opportunity because the bulls are running out. Your EMAs are on top of the histogram. Your red line is on the bottom of the blue and the yellow. So you know that you're looking for a sell opportunity in the market. All right, so we're going to go ahead and we're going to wait to see what happens. All right, so we have the cross of the MACD and signal. We have the cross of the MACD and signal. Here's our cross of the MACD and signal. All right, there we go. There's our cross. We also have the bears are getting strong to come in. The bears are getting strong to come in. So now what we're going to do, we're going to set our trade up. We'll set our trade up, spread times 2 above the we're going to short the market, spread times 2 above the high. Spread times 2 above the high. Wow. All right. 15-minute time frame, and we're going to do a 1-to-2 ratio. 1-to-2. All right, 1-to-2 ratio. So now that we have our trade set up, we have our confirmation early entry versus conservative. We get into the market as we're looking at these here. Now, again, for my scalpers, you're looking for what, 10 to 20 pips at more, if that. But we're looking at our histogram. Nothing says to get out of our trade yet. Because why? Nothing has crossed yet. Nothing has crossed yet. Continue, continue. All right, so now that you're in profit, look at your histogram. Look at your histogram. Nothing told you to get out. There's no bulls. There's no only bears. Only pullbacks. Only bears strong. Bears getting weak. Bears getting strong. Bears getting weak. A bunch of strong, and then they're pulling back. These are all pullbacks. The light is the pullback. So we're looking at this histogram. Nothing says get out. All right, we're just in drawdown. You're in maybe a 6-pip drawdown, 7-pip drawdown. All right, so continue on. Now that we're getting below the histogram, what are we looking for? Are we staying in this trade or are we getting out this trade? Correct. Now that we get out, now my scalpers. Correct, we're getting out. Now we are scalping this. We're scalping this trade, correct? MACD, we said we're used for scalpers, right? Scalpers are looking for how many pips in the market? At most 20, correct. At most 20. At most 20. At most 20. So if you're scalping, you got your 20 pips right there. Type of 5 in the chat if you see that. If you were scalping, you got your 20 pips already in the market. Correct. You already got your 20 pips in the market. You were out of the trade already. You got in. You got your 20 pips. You look at your histogram. You see that this getting ready to pull back because while you got this bar right here, we have this bar getting ready to pull back. We see it right there. Getting ready to pull back. And what does it do? Pulls back on you. Pulls back. You exit the trade. There's no more scalping. You exit the trade, but you exit the trade at 20 pips because why? You're looking for your scalping exit. This is a scalping exit. These are scalping entries. MACD is used for your scalping. All right, we'll do another one. Type a 7 in the chat if you can see the entry and the exit. A 7 in the chat if you see the entry and the exit. Again, this takes practice, guys. If this is your first time seeing the MACD, this is just going to take practice. Don't worry, this video is going to be recorded. You can go over and over and over. Nothing secret behind this. I've tried to make this as simple as possible. This is for you to get in the market and to get out of the market. In and out. In and out. It also works on higher time frames, guys. Works on higher time frames. Let's get a not so consolidated market. Let's try that. It's been not so consolidated. So this market's trash. Any questions, guys? Any questions? It is simple, yes. Make it as simple as possible, guys. Make it as simple as possible. Any questions? Let's say all right, let's do it again. AUD USD. We have our candles here. All right, we have the EMAs on the bottom. So what are we looking for? What are we waiting for next? We got the EMAs on the bottom. So what are we looking for? What are we waiting for? We're waiting for overbought or oversold. Oversold or overbought. Which one? Correct. Oversold. We're waiting for that oversold signal. All right, wait for the oversold signal. All right, so where's our red line? What's that indicate? Where's that red line indicate? Look where it's at on top. So what is that indicating? Indicating our buys. Indicating our buy. Correct. Indicating our buy. So therefore, we're going to see what this market gives us. All right. So we see our signal right there. Our signal's here, the cross of the blue and the orange. So we know the market's oversold. All right. EMAs on the candles have not crossed yet. EMAs on the candles have not crossed yet, but that is okay. If you're an aggressive trader, you're going to get in here. If you're conservative, you wait for this cross of the EMAs. So we long that position right there. Spread times 2 above the, or sorry, spread times 2 below the wick, below the day. Spread times 2. All right, spread times 2. All right, we have our EMAs. We have a 33 pip stop loss versus a 85 pip gain. All right, so let's get in the market. Stop out. Are we in or out? Look at consolidation. Good example here. When you see this, right, this consolidation right here, it's a consolidation in the market. Look at your consolidation in the market. Consolidation in the market. Type of 5 in the chat. We see the consolidation in the market. Consolidation in the market. Correct. Correct. If you got stopped out, what are you going to do on this? You know where it's going, right? So what are you going to do? You got stopped out. What are you going to do? Going to get back in a re-entry. Get back in for a re-entry. Correct. Re-enter the trade. Just because you got stopped out, you know where it's going. That means your stop loss was too short. That means the market did not want to continue to pull back down or pull back up. All right. Did not want to pull back up. So you get back into the trade. Move the drawing here. Get back into your trade. You go back in. You long the market. Spread times 2 below the low. A 1-to-2 ratio. That's the difference between guys. When you guys get stopped out, some of you guys get stopped out and you just completely stop trading. You know where the market's going. Get back into the trade. So now you're back in profit. You break even. And you profit. There you go. There's a break even and profit right there. You hit TP, so you have another TP. Nothing says get out of the trade. All right, are we in or out of the trade? Are we staying in or are we staying out? Are we staying in or are we staying out? We're getting out. Getting out of the trade, just like that. Simplicity, guys, simplicity. In the market, out of the market. In the market, out of the market. That's all you're looking for. This is what this is used for. You're not trying to hold trades on this. Now, I want you to write this down. The MACD does not account for wicks. Like the TDI, the MACD does not account for wicks. That is why those stop outs can happen. Those wicks are not accounted for on the MACD. You cannot see that is the rejection as well as on the TDI. All right, so don't try to compare it to your TDI. Don't try to compare it to your TDI. All right, type of 5 in the chat, guys. This is simple for you to use. This is for my good scalpers. This is for your scalpers.